There are different types of assets investors can buy and sell in the stock market. The most common types of assets include the followings. 1. Stocks. 2. Bonds. 3. Mutual funds. 4. Exchange-traded funds, ETFs. 5. Derivatives. Now let's briefly learn the definition of each asset type. Stocks represent ownership in a company and can be bought and sold on the stock market. When you buy a stock, you are buying a small piece of ownership in that company. Thus you become a shareholder in the company. As the company grows and becomes more valuable, the value of your stock may also increase. You may be entitled to a share of the company's profits through dividends. A bond is a debt security that is issued by a government or corporation to raise capital. When you buy a bond, you are lending money to the issuer in exchange for regular interest payments and the return of principal when the bond matures. Bonds are generally considered to be less risky than stocks, but they also offer lower potential returns. A mutual fund is an investment vehicle that pools together money from many investors and uses that money to buy securities. They usually make a diversified portfolio of stocks, bonds, or other securities. Mutual funds offer investors the opportunity to diversify their portfolio and access professional management. Downside is that they also come with fees and expenses which can reduce returns of your investments. An ETF is similar to a mutual fund as they offer investors a way to buy a diversified portfolio of securities. Unlike mutual funds, an ETF is traded on a stock exchange like a stock. ETFs offer investors the opportunity to buy and sell a basket of securities in a single trade, and they often have lower fees than mutual funds. Derivative is a financial instrument whose value is derived from the value of an underlying asset. This underlying asset can be a security, such as a stock or bond, a commodity, such as gold or oil, or a currency. Derivatives can be used to hedge risk, speculate on the price movement of the underlying asset, or to generate income. Derivatives can be three main types. 1. Options. 2. Futures. 3. Swaps. Options are financial contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price on or before a certain date. There are two types of options. 1. Call options, which give the holder the right to buy the underlying asset, and 2. Put options, which give the holder the right to sell the underlying asset. Futures are contracts to buy or sell an underlying asset at a specified price on a certain date in the future. They are commonly used to hedge against price fluctuations in commodities, currencies, and other assets. Swaps are agreements between two parties to exchange streams of payments over time. They can be used to hedge against fluctuations in interest rates, currency exchange rates, and other financial variables. There are many other types of assets that can be bought and sold on the stock market, including commodities such as gold and oil, and real estate investment trusts, REITs. It is important for investors to understand the risks and potential returns of each type of asset before deciding to invest. Thanks for watching. If you enjoyed our content, please like and share it. And don't forget to subscribe for more videos. We appreciate your support and can't wait to share even more amazing content with you.